The U.S. Department of Housing and Urban Development, or HUD, announced earlier this month that some of the proposed changes to the HECM for Purchase program, or the H4P, have been modified from the original proposal that we saw in the Federal Register, more specifically to the practice of premium pricing. Now it'll only allow interested party contributions on H4P closing costs from property sellers, builders, real estate agents, and developers. This came after concerns were raised in the public comment period following the proposed H4P changes, which were announced late last year, and some of those comments even came from AARP. So some of the planned updates will not be implemented, according to a statement from the Federal Housing Administration. So we're going to dive into just what has been removed from an allowable contribution. A mortgagee letter detailing the particulars of this policy change were released in conjunction with the Federal Register. Back in October 2023, FHA published proposed guidance for the HECM for Purchase program in the Federal Register, and it allowed in certain circumstances for the inclusion of an interested party contribution, or IPC, of up to 6% of the sales price. At least that was the original plan. But after concerns were raised during the comment period, the public comment period that is, and they were brought to the attention of the policymakers, they have decided to curtail or walk back some of those plans. But not all hope is lost. FHA will move forward with its proposal that does permit contributions by the property seller, real estate agent, builder, or developer for the HECM for Purchases closing costs. So we're still keeping those. However, at this time, FHA adds they will not allow lenders or TPOs, third-party originators, to make those contributions, nor will it allow premium pricing to be an eligible funding source to meet that borrower's minimum required investment. So the new guidance, as published in the Register and the mortgagee letter, will be restoring the previous policy that does allow contributions, but it's not going to allow that from the originators or from the third-party originators or TPOs. Now, the effective date, which was announced last fall, by the way, does remain in effect. That was April 29th, which means we're already a week into it. So for more details, you can go to the Federal Register, and we've included a link here on this page. Last week, I came across a distressing column in the Belleville News Democrat entitled, "A Belleville Duplex is Deteriorating." HUD and a squatter are calling the shots, they say. Half of a West Bellevue duplex is falling into disrepair and has now become a headache for city officials, police, neighbors, and an alderwoman who is, quote, frustrated beyond belief. By the way, Belleville, Illinois is situated 90 miles south of Springfield, Illinois, and 20 miles east of St. Louis, Missouri. The man who owned and lived in the duplex unit died 5 years ago, apparently with no will. But since that time, it's been tied up in the bureaucracy and perhaps the courts with intestacy, which basically means HUD has inherited the federally insured loan property or the property lien on that HECM property. But to make matters worse, now we have a squatter who took possession early last year, and they refused to leave, as squatters do, and police cannot force entry without a court-ordered eviction, that according to city officials. The woman has removed HUD-ordered locks on the doors and replaced them with her own and repeatedly signed up for utilities using fake names, said Scott Tyler, the city's director of health, housing, and building. So that squatter is very creative. When I asked HUD what their next step is, they said they were going to sell it, and whoever buys it is going to be responsible for getting the squatter out of there, he said. In January, the city and a nonprofit organization called the West End Redevelopment Corporation asked for assistance with the problem at the unit on Foley Drive from U.S. Representative Nikki Baczynski, a Democrat in the 13th District of Illinois. The organization, even offered to purchase the home. According to Baczynski's chief of staff, John Lee, her caseworkers reached out to HUD representatives who told them that squatting is a, quote, local law enforcement issue, and the agency is planning to sell the loan this year to an eligible bidder as part of an asset sale, which we covered asset sales in an earlier episode. The new servicer will move forward with foreclosure to get title to the property, and then they can sell it, wrote HUD Representative Kimberly Dana in an email to Baczynski's caseworker. So today, this fully drive duplex unit is assessed at $44,000 plus. Now, that's just 1/3 of its market value of $132,000, although other units in the same complex have sold for significantly less in recent years. In the meantime, the unit continues to deteriorate. Shingles are falling from the roof, black mold is growing on the exterior of the duplex, and paint is peeling off the garage door, and of course, trash is strewn throughout the yard. So this just shows the increased need to get these properties that have been in a reverse mortgage and go into technical foreclosure or the last borrower dies. They need to be disposed of quickly. Otherwise, the taxpayers are losing money that could be recouped from a home that is sold in a very timely manner without the deterioration and damage that comes with an empty unit without power in most cases, heat or air conditioning, and this leads to also frustrated neighbors. So we're hoping to see improvement in this most important area of HECM servicing and how properties are disposed of, and we'll keep you apprised if we hear any developments on that front. Florida is facing a mass exodus as insurance costs continue to climb. The increasing cost of homeowners insurance in Florida is pushing many residents to give up on their coverage partially or altogether, to sell their home, and in some cases, even to move out of the state, readers told Newsweek. Some have already taken the plunge and left the state that they once considered to be heaven on earth. Florida's insurance premiums are the highest in the nation, that according to a recent study by the Insurance Information Institute, and they have tripled in the last 5 years. Residents are currently paying on average now more than $4,200 per year, while the national average is $1,700, according to the Institute. Skyrocketing costs are made worse by an ongoing insurance crisis that has seen 15 major insurers, including Farmers, deciding to leave the state over the last year. Many cited the increased risk of extreme weather events in the state, which scientists attribute to global warming as one of the reasons for pulling out of the state. A dream that turned into a nightmare. While Florida continues to be an attractive destination for many Americans that are thinking about moving somewhere that's more sunny and with relatively lower taxes, it's attracted far more residents than any other state in 2022. The increasing unaffordability of homeowners insurance is leading some to move out. According to the U.S. Census Bureau, an estimated 275,000 plus people left Florida in 2022, a number that's certain to even be higher in 2023. In closing, a word of caution to those of you that are working in the Florida market for reverse mortgage origination. Keep your eye on property values in different counties and metros, because you could see home values begin to soften if this exodus continues and it increases housing inventory. And that's a wrap for us here at HECMWorld Weekly. Thank you for joining us for the nation's only weekly podcast bringing you reverse mortgage news for mortgage professionals. Don't forget to subscribe, whether it be on Apple Music, Spotify, or Podbean. And we'll see you here next week for more reverse mortgage news on the go.